Welcome to Shri Management channel. Today we are going to talk about smart tax saving strategies for homeowners. I'm going to discuss 5 key ideas and of course one bonus idea at the end of the video. So please watch this till end of it so that you'll make most of it. Key strategy number 1. This is for you in case if you are having a home and using that for your personal use, of course staying in that. So the idea here is that you can avail deduction of interest on the home loan taken. So you have taken a loan for the purpose of construction or purchase of the house, then you can use the deduction from the interest on the home loan. There is a maximum limit of 2 lakh rupees of the interest amount to be claimed. Let's say that other alternative is if you have taken a loan for the purpose of repairs or renovation, then the deduction can be claimed up to maximum of 30,000 rupees. There is an additional case as well. The interest on the loan during pre-construction period can also be claimed. So a pre-construction period means is the period prior to the previous year in which the property is acquired or constructed. Let's say that you have bought a home in the year 2023. The period prior to 2022 is the pre-construction period or pre-acquisition period. So the interest amount during that period can also be claimed. This amount can be divided into 5 equal installments and it can be claimed up to 5 years, commencing the year of acquisition or completion of construction. In case of the interest in the current year, you can claim the complete interest during that year itself. Of course, there are certain key conditions which you need to follow here. These deductions can be claimed if you are opting out of the default tax regime. That means you have to be in the old tax regime and you need to have the certificate from the bank or the financial institution from which you have taken the interest. So with that, you can use the upper limit of 2 lakhs in case of a home loan or up to 30,000 in case of loan taken for renovations. And that will be substantial help in reducing your tax amount on the overall tax calculation. Because if you're staying in the house, you do not have any other income source. But if you have income from other sources, then this would definitely help in reducing the overall tax incidence you have. And strategy number 2 is for you in case if you're letting out the property. So in case if you let out the property, then consider deduction in case of municipal taxes paid. These deductions are on the gross annual value of the rental income. So in case if you have paid the municipal taxes during the course of the year, you can avail deduction for the tax amount. That can be substantial amount. Let's say sometimes it is like up to 5 to 8% of the total value of the gross value. So you can avail the municipal taxes which you have paid to the government of India. And the other deduction in case of letting out property is the standard deduction of around 30% on the net annual value. This is a flat amount, so you can use that deduction for your benefit. I have created a separate video how to you calculate the gross annual value and how do you arrive at the net annual value of the rental income. I will provide the link of that in the detailed section below. Please do have a look at that. Apart from this, municipal taxes and the deductions basing on the 30%, and net standard deduction, you can also avail the other deductions what I mentioned in case of self-occupied property, also in the case of let out properties, so that you can get a much better deductions on the rental income. Of course, these deductions do play in if you are in the old tax regime. And third key strategy is try having an ownership of the house in a joint way. That means that try having a member of your family and you co-own that. Let's say if your spouse is earning and you can also have the property ownership with your spouse together, it will have a much better benefit than owning it individually. So in case of the dual ownership or the co-ownership, then each owner can have up to 2 lakhs of limit in case of home loan interest and 30,000 of limit in case of loan taken for repairs and renovations. So that is for the self-occupied property. So each of these owners will have an upper limit of 2 lakh rupees, which is a substantial deduction on the total rental income. And in case of let out property, the income is calculated as if the property is owned for the single person, and then the income is shared between the two co-owners as per their specific share, so that you can avail much better tax benefit if you try having a joint ownership. Strategy number 4, in case of let out of your property, is to have this rental agreement written in a better way. What I mean by that is, often when you are letting out your property, there will be charges for the rent, and apart from that, maintenance charges, let's say parking, lift, and other maintenance charges included in your rental package. So when you are writing a rental agreement with your tenant, make sure that the tenant pays the maintenance charges to the society or the building association directly, so that you don't get that amount counted in your rental income. By that way, you would be receiving the rental income directly, whereas the tenant would pay those additional charges to the building association, and your tax incidence would be reduced. And another key strategy here is that, let's say in case if you're having more than two properties, then the income from any of the two properties is considered as deemed let out. Yeah? When I say deemed let out, that means that they are bound to be considered as let out, though they are with you under self-occupation. So for the purpose of tax saving, remember that income tax rules allow the owner to choose which of the property can be considered as deemed let out. So because each of the properties would have a different gross annual value, so considering one of them as your self-ownership and the rest of them as deemed let out would give a better tax leverage, and then you would have a reduced tax incidence as well. So that you can consider that option. And you can also avail the deduction of municipal taxes in case of deemed let out properties, yeah, for all the three properties. A bonus tip here is when you are having a deemed let out property, you can change one of them to the self ownership and the rest of the other as a deemed let out property at every year. So that you as a taxpayer can get benefited. So always check out your rental income in case of deemed let out properties by verifying which of the calculations, whether the old tax regime or the new tax regime, will be benefited. Often you will be surprised because that can give you a much better tax saving depending on the property what you have chosen to be self-occupied versus rest as deemed let out. And I have a detailed video for you. How do you choose this and calculate in one of my other videos? I would provide the detail of that in the description. Do watch that as well. Hope this video is quite beneficial to you in order to avail better tax benefits when you are having a rental income or an own house. Thank you for watching. If you have questions, please comment in the section below. And of course, don't forget to subscribe. Thank you.